Of course, we just heard some sound from Fed Jay Powell on the market landscape ahead. So joining us now is Marianne Bartels, Managing Director and Chief Investment Strategist at Sanctuary Wealth. Thank you so much for joining me, Marianne. So
Oh, thank you
obviously,
for
we
having
heard
me.
from Jay Powell. Of course. We heard from Powell that he's focusing on a number of things. Obviously, the JOLTS data came out while he was already testifying, but you have the jobs report out Friday, CPI, PPI, retail sales data coming out in the days ahead. How are you positioned? Obviously, the Fed is still trying to make up its mind about a 50-point basis hike at the next meeting.
Well, what we've been telling our clients is that as long as the Fed is raising rates, asset classes like equities and fixed income are going to remain volatile. And what we got out of the testimony yesterday is the likelihood that the Fed's going to go back to an increase of 50 basis points. But I have to say, given that expectation, I thought the equity markets handled that new information quite well. Yes, they were down, but if something like this had happened, back in 22, I think the markets would have been down like 3%. And we actually saw risk assets like NASDAQ outperform the S&P. So yes, the markets are digesting that rates are going to continue to go up. They're going to stay higher for longer. But I feel that the market is really well positioned for that. I think where the risk would be is if they continue to press rates and then rates eventually go to 6%. That's kind of been our target where, asset classes won't be as happy.
Indeed. I mean, we're looking at some of the commentary here. We know that Citi is expecting that 50 basis point hike at the Fed's March meeting, with terminal rate raised to between 5.5 and 5.75%. Goldman, a similar range for them as well. They're also expecting an additional rate hike in July. What are your expectations in terms of the pace of the rate hikes and the size that we're expecting this year?
Well, I have to say that the Fed has been very good at communicating that they're data dependent. And they're going to react based on data. And the data that's coming out is having inflation really not go down. And employment, I think, is they say inflation is sticky. I think employment is a little sticky because, as you mentioned, we got JOLTS higher than expected. We got ADP higher than expected. In addition to that, the revisions were higher. So the data is a little bit stronger than the Fed wants. So they're going to react to that. But I think that's why the market is acting so well. If you looked at 5-year break evens yesterday, they came down sharply. They're happy that the market is starting to price in 50 basis points. And as I said, I think equities handled it very well. The front end of the curve did what it was supposed to do. It was going to go up. And you are seeing, the yield curve flatten out even more, the worst since 1981. And what I feel is happening is you have a fight between monetary policy and a fight between fiscal policy. And because we had such great stimulus during the COVID period, and we're having fiscal stimulus from President Biden, you have the CHIPS Act, you have the Inflation Protection Act, that we don't really have models to understand how to model all this stimulus, even though the Fed has been tightening now for almost a year. And I think this is important. Coming up on March 17th, this is going to be the 1-year anniversary that the Fed began to tighten. And as many of us know, there's a lag to monetary policy of 12 to 18 months. So we're really just moving into the period where we're going to start really feeling the effects of the rate hikes. And we probably don't talk enough about quantitative tightening or the roll off of the balance sheet. So I think as we move into 2023, we'll have a better idea of how the rate hikes and the quantitative tightening has actually impacted the economy.
Because when we did hear from Powell, he was saying that he didn't think that they tightened too fast or too much at this point. But you have Bank of America Chief Executive Brian Moynihan predicting a very slight recession beginning in the third quarter of this year. But as we keep an eye on things like the inverted yield curve, what are the signals telling you? Are you also expecting a slight recession, and will it happen this year versus what we'll perhaps see next year?
I think, as I said, because of this fight between monetary and fiscal policy, we're having a hard time predicting when the economy is going to slow down. What we're watching as a barometer is initial jobless claims, because the part of the economy that remains very robust, which is what Powell talked about yesterday, was employment. And they want this to slow down. So I think the leading indicator that will help us be able to determine when the economy will begin slowing down is by watching initial jobless claims and then watching employment every month. So it's definitely months away before we have probably official recession. But of course, the NBRE is the one that actually confirms whether or not we've been in a recession. And many times we don't find out we've been in a recession until we've been in it for quite some time or since it's passed. So I think it's going to be quite some time before we even know if we're officially in a recession. But definitely watch employment as the key barometer as to Fed policy.
And so, Marianne, we've seen over the last year the 60-40 allocation model really been hammered by a lot of analysts. You say it's making a comeback, and you also say in this bear market, you see buying opportunities. What is your strategy in this environment then? What opportunities do you see?
Right. So we see opportunity. There's always opportunities in any kind of market cycle. It's about finding them. So in terms of 60-40, because for 14 years, we really didn't have interest rates, we couldn't get, a good amount of income. We had TINA. There is no alternative. Everybody went into equities and wasn't really well diversified. It was never going to be easy to go from a zero interest rate environment to where we are now. There was going to be pain, and we've been through the pain. We may have a little bit more as we're probably getting close to the end of the Fed tightening, but now you can really build out a portfolio with stocks, bonds, and cash. We're seeing great demand from our client base to really go after some of these high yields that are now in the 5% range in treasuries. In terms of equities, you really want to be selective. We think the pocket that you really want to continue to avoid is what we're calling the mega cap tech. But if you really look at part of the cyclical part of the market, if you look at industrials, they're doing really well. Aerospace and defense, parts of machinery are doing well. Parts of transports are doing well. And we think this has a lot to do with the infrastructure bill and the spend that's happening. Semiconductors within tech are doing well. That partly is due to the CHIPS Act and the investment that's going into that part of the market. So you really want to hone in on specific areas. We also like small and mid cap, very well priced relative to the S&P 500 and very well priced relative to history. So you really want to be diversified. You want to stay with quality, and you can really build out a portfolio of stocks, bonds, and cash.
It certainly seems like time to go shopping there. But as you mentioned, they're being selective in the process. Marianne Bartels, Managing Director and Chief Investment Strategist at Sanctuary Wealth. Thank you so much for joining me this morning.